What's up, guys? Sam here, and I'll be doing the weekly market review for the week ending in January 16th, 2026. So another week is in the books. Happens to be a rather large one, being that it's monthly OPEX. So lots to take a look at. A lot of sideways action in some parts of the market. So this should be a relatively interesting video because not a lot of things are syncing up. So let's dive into the indexes. We'll try to make some sense of this, and then we're going to go from the indexes. We'll go to the individual sectors, which is something that I'm trying to add to the videos. So we're going to be looking at individual sector work. We'll then look at credit markets as a confirmation for risk, and then lastly we'll finish with the VIX and try to put it all together into an actionable plan for next week. So the candle has now closed on the week, and it's a very exciting candle. Very exciting there. Nice little doji candle, basically an inside candle. And if we do our candle work here, I don't really know what to make of this one. I guess that's the nature of the inside candle, right? You did make a new high, but I'm not necessarily viewing that as a great thing because it actually appears to have made a lower close. And I'm not entirely sure if that's a lower low or not. But it's basically just a glorified inside candle. The main concern that I have here is that I gave you this target last week of 694.45, and while we did exceed that by about $1 and change, you know, it's kind of a closing level, right? And notice how we can't close above it. Last week we hit the level, we exceeded the level, we closed right below the level. This week we exceed the level by a little bit more, and we closed below 694.45 yet again, right? So the more that this happens, the more that this actually starts looking a lot like distribution to me, right? And while I understand that there is a pattern of higher highs here, this ultra tight compression that's forming here is not necessarily a pattern that I'm really overly enthusiastic about, because if you ask yourself, where's the stops? Well, the stops are probably below that low, or below that low, or below this low, right? And you can see here that if they start to trigger, one sequentially triggers the other one, and next thing you know, you're looking back down here, you know, at these lows, which are much more significant. So this isn't a great pattern in my book. And there's just a couple little issues here, right? So briefly, I'm just going to talk about the indicators here because they're going to look a little bit different than what you're used to, and they'll have a couple different labels here, but it gives more information, and the indicators are a lot less noisy, especially the trend oscillator. So let's kind of interpret this for the first time here. So you do have a negative divergence into a new high, not good. You have a negative divergence here, again, also not great. The weekly chart remains unchanged, right? It is a max bull chart. It hasn't even closed below the weekly 10, so not a big deal there. But the fact that it's stalling out, losing all kinds of momentum underneath that critical level, and again, I'll just briefly cover as to why that's a level. If you measure your Fibonacci's from the tariff high to the tariff low, it prints a 1618 target basically at 94.45. So that's why that level's so big. So not loving the action here. Let me show you kind of a problem that I'm seeing from the inside out. We always spend a little bit more time on SPY, and then we'll speed it up here ideally as we move along. But let me show you this 4-hour SPY here. There's a 4-hour squeeze. The 3-hour squeeze that I had been kind of hanging my hat on has already fired, and it fired in a rather spectacularly boring way, right? It actually fired, but it didn't do anything. So there's no more 3-day squeeze that I see. There is a 4-day squeeze and there's a 4-hour squeeze, but they're not exactly of the winning variety, right? So you see how on the indicator there below, you see the double red lines. So basically what this means is that all of this, basically from here to here, this is all a very weak high, right? Despite the fact that it's trying to go higher and higher, you see how it's going higher and higher on a double red condition. So if at any point it gets an arrow that cancels out the bull slingshot that you currently have from the indicator below, then this indicator takes precedent. And frankly, you know, I think that this kind of shows it a little bit more clearly. I told you that where's the stops? There's going to be stops here, there's going to be stops here, there's going to be stops here, and there'll be stops basically all through here as well, right? But the more intermediate one, you can see that if we trigger here, you then immediately almost snap to the next set of stops and then the next set of stops. So not a pattern that makes me overly comfortable, to be honest with you. Not a big fan of the way that that looks, and the fact that it has a squeeze with a negatively diverging trend oscillator is not really my cup of tea. So what does this tell me? Well, it's too strong to short. Although, you know, putting a stop on a weekly close above that 94 half strike does make sense, right? So from a risk to reward perspective, the short seems to make more sense here than the long. But just keeping it, you know, honest about how I'm going to trade this. This appears to be more of like a impending volatility that could go in either direction. My bias so far with just one stock down is that it's more than likely to flush it. But because it is so strong on the weekly chart, as you can see there on the left-hand side where it's a max bull, I actually prefer to just come in and day trade it with maybe a little bit of a short bias, but keeping an open mind to both sides. So that was the in-depth on SPY. Let's go to the Qs. So in the Qs here, the Qs actually do have a 2-day and a 3-day squeeze. The problem is that the Qs have no participation from the Mag 7, which makes things difficult. So here on the Qs, a lot of the same stuff, right? A lot of the same stuff. Weaker than SPY, certainly, on both ends. You can see here that this level, basically the exact same level I gave you on SPY. This is just the Q version. It's 26.35. We got up there today, close to it. We got to it yesterday. Poked above, failed, and still are closing below. And then this one has a really gnarly pattern here, right? I don't view that as a bullish pattern. I get that it has higher highs, or higher lows, I should say, and kind of a flat top. But again, these patterns are very susceptible to very quick flushes for the very reasons that we just covered. And then if you look at the indicator down here, this has been all happening in a negative orientation. So not really a huge fan of that. We'll take a closer look once we get to the mags here in just a second, what that looks like. But the problem right now in the markets is, at least the way that I'm seeing it, is that they've parabolically moved a lot of the parts of the market that weren't in tech. So that would be a lot of the IWM stuff and a lot of the components inside of that. But that stuff is basically really overly cooked at this point. And so from a rotational point of view, the market needs to find new leadership, right? I don't personally think it could just be the IWM with the mags languishing this long. So let's zoom in here. I have two levels here on the Qs, or excuse me, on the IWM. And levels 65 to about, looks like 67.6, which is kind of where we've made the target already. So we kind of already have gone to one of my longer term targets, which was 67.6. We got about 40 cents away from that. This chart looks great, right? Unlike the other charts, this one, you know, you can see it for yourself. It just pops. It looks very nice, very pretty. However, it's very extended, right? It is quite extended from any kind of support here. And while that's that can persist, and certainly would be the place to continue focusing, it does kind of create more of a necessity for a rotational element to come through. So the IWM here being an absolute boss, not that surprising because it has had a good score for a while, and that weekly squeeze is just doing what weekly squeezes do. So those are the three main ones. We don't usually look at the Dow. Kind of ends up as a tweener in between the NASDAQ and the S&P. So let's jump over to the sectors. And then we'll go to some bonds. So these are all the indexes, not the sectors, but I like to start here. SPY's a 50%, Qs are a 30%, DIA, IWM, both at 100%. The Mag 7 basket is at 15%. The QQQ equal weight is at 50%. So this shows you the discrepancy massively here, where the equal weight QQQ is actually up significantly better than the Mag 7. This is unusual, right? Normally we see it the other way around, where the Mag 7 is leading and the QQQE equal weight is actually lagging. You can spin this as a positive, but if the Mag 7, and we have to go back and take a look at this chart specifically, because this is a really important one, if the Mag 7 actually don't play ball, then the QQQE signal just gets wiped out pretty quickly. RSP looks great, which is equal weight S&P 500, and then world markets still look good except for China. So let's do this. Let's go back to our main chart. And although we don't always do this, I'm going to look at the Mag 7 index with you. If you don't have it, you can grab it from last week's video. Just go to last week's video with me and grab it from the description. And I think this might be one of the first times that we reviewed this chart. But this is an important one. You have to see this signal. So here's the Mag 7 index. Again, this is a collection of all of the Mag 7 stocks properly weighted for price and market cap. So it reflects, a good chunk of market cap here. It's almost, $10-15 trillion worth of market cap between these components of Apple, Amazon, Avgo, Google, Meta, Microsoft, JPM, Palantir, and Nvidia, Tesla. So I think the direction of the market is really going to be determined by this chart. Now, let's kind of zoom out a bit here. I always want to make the videos shorter, but sometimes we just gotta gab. And this is one of those times. Alright, so what do you see? Well, I see a lot of warning signs here. It has a red MACD, it has no trend, you have double red lines. You've had double red lines for a long time now. It has a negative divergence, and it has a failed breakout banner. On the weekly chart, it has a negative divergence, and then the squeeze histogram. You see how the squeeze here is magenta? This is a high compression squeeze. These are the most likely squeezes to actually fire against the trend. So in this case, you have an uptrend here. And when you have a high compression squeeze, those are actually the most likely to break against the trend, right? So I combined all of this stuff and I asked myself, okay, well, what's going on here? And the momentum here is not particularly good. It has not gone full bearish, but you see how the momentum label there is purple? That means that it's close to being bearish. And when you have so many negative divergences like this and failed breakouts, and then you top that off with a high compression squeeze, which is, again, the most likely to break counter trend, this is a very precarious spot here. For specifically the mags, but really for the overall market, because if this signal is true, I think you bang out the mags here for 5% probably in a week, right? I would look for it to get back to this low here, and that's about 5% lower, right? That's just the only place that there's really any support. You have a high compression squeeze here as well, and this is the first time you've had a high compression squeeze or any squeeze with a negative orientation all the way since back here when you had buy signals. Right, so this chart alone actually could be the entire video, because this chart, if you get what I'm putting down, and hopefully you just look at the indicators and it's really crystal clear now as to how it all works, and double red lines and down arrows and red banners, not good things, right, and green lines and up arrows are good things. This chart is a mess, and while it contains bullish properties in terms of if you just looked at it without indicators, it would look like a bullish chart, especially on the weekly time frame. The underlying momentum is actually considerably bad here in the Mag 7. So basically what this boils down to is everything looks good except the Mag 7, and everything that looks good has run parabolically. I'm slightly exaggerating there, but you get what I'm saying if you look at things like XLI or something, or IWM. So the things that look good are trading 400 ATR, and the things that don't look good, which are the most important things, all have like this kind of wily coyote pattern of like they've jumped off a cliff but they haven't recognized it yet. So very precarious spot here. Again, the market remains too strong for me to just come out here and beat my chest and say it's a short. But for me, it's definitely not going to be an easy, clean long, especially in the mags. So with that in mind, I significantly prefer day trades here. So that was that. So let's jump over to the HYG. Actually, you know what? Let's kind of keep a theme going here. So I just showed you the Mag 7 index. Let's look inside of it. And let's just, because there's no bigger story here, right? Like, than what's going on here. And if these stocks don't perk up very soon as a basket, as a collective basket, then I do think that the signal will fire short, and I think it'll fire short in a rather dramatic way. So these are all the components of the Mag 7 index. Let's see what they look like. All right, so you're going to see, I think, one bit of green, and then everything else is going to look terrible. And you can probably guess where the green is. It's in Google. But here's a perfect example, right? Google looks great, but that's literally a parabolic move right there. Right? That's x. What is it? X2 that makes that pattern, the parabola, x squared. And then everything else here looks kind of, you know, as a youth would say, it looks kind of mid, right? You got Avgo negative 50, Meta negative 85, Tesla negative 10, Amazon's neutral, it's okay. Palantir negative 5, Microsoft negative 85, Apple negative 60, Nvidia is at 0, the index as a basket is at negative 15. So there's going to be a definitive need to focus on the Mag 7 next week more than we've seen in a long, long, long time. Going back to the beginning of the rally, I would say. So now that we have that kind of verified, it was something I already kind of knew, and you probably already saw it too, but I think showing you the momentum signal under the Mag 7 really puts a point on it, right? Because it's not like, oh, that's, you know, if you look at that chart from across the room without any indicators, it's a bullish chart. You're going straight up, you're trending, you're still above the weekly 10. Nothing wrong there. You know, you would argue that it's just trading in a sideways pattern after a long rally. You know, it's accumulation, and then it's going to go again. And it, you know, I'm not going to say that that's not going to happen, but from a probabilistic point of view, which is what we do as traders, the probabilities at this point don't favor that. The probabilities at this point favor that this is in fact distribution, not accumulation, and that a tiny break in the structure creates a stop run that becomes cyclical until the next thing you know, the NASDAQ's down 5%. So if we flash over here to the bond market, this is still flashing good. So there's no major issues here. I would imagine if there was going to be some major issues, it would show up in HYG. But this chart just continues to nominally improve. It's become a bullish chart. You have a weekly squeeze here. The weekly chart's gone bullish. Nothing wrong here. Fresh little arrow here. We like that. Squeeze looks proper. So this is a big point for the bulls. And this kind of takes the edge off some of the anxiety that I was seeing in the Mag 7 chart. So that takes a bit of the edge off. So that definitely is a full point for the bulls. Let's go over to the VIX. Also be careful next week because on Wednesday, and mark this on your calendar, Wednesday is VIX expiration, and it's a rather big one. So usually after VIX expires, that's when the market becomes a little bit untethered from all of those options rolling off. So think of it kind of like the market kind of has like a safety net underneath it from all of those contracts on VIX. And then once those contracts expire next Wednesday, that safety net is reset. And then a new net develops at some point. But that cushiony effect rolls off on Wednesday. So be aware of that. In terms of the VIX here, it's sneaky. You have to go inside the thing to see it. Let me show you what I'm looking at. So from the outside in, the VIX hasn't done anything to register a signal on the daily chart, much less the weekly chart. But you always want to watch it because the VIX likes to coil up, right? It's like, surprise, here I am, just after everybody got really super complacent. So you see how the red line here, this is the hourly 200, you have a very strong slope down. And now it's kind of flattening out. And you see how the VIX is now starting to actually acknowledge that red line is now as support, which actually held as support the entire day. Kind of have a double bottom there. And in doing so, you've now gone into a positive divergence with a positive crossover here. So it's a sneaky signal, and it kind of, putting it all together, what I'm seeing here is actually something like a potential rally on Tuesday that I would probably be looking to sell into, right? Because from what I'm seeing, and again, give me a little bit of leeway here because I'm calling the market 4 days out when the signals aren't particularly good, so I can't just come on the mic and say, oh, just buy everything, and it's just the easy market that we've gotten used to. From what I'm seeing, I think we could have an up day on Tuesday, and then I would be really cautious going into Wednesday because of the VIX complex and because of these signals that we just saw on the Mag 7 index. So what to do? Well, I'm just going to talk on my plan here in terms of how I'm seeing things. Of course, for those of you in the room, I'll do the weekend work, and then I'll give you the weekend work on Tuesday when I see you next. Although I'm not in the room on Tuesdays, but I'll still post it, and then I'll see you on Wednesday. And what we'll do is, or at least my tentative plan, is to hold the longs until Tuesday, and then potentially look to pick up some shorts for Wednesday. Now, I don't want to jump the gun. Again, if I'm being true to what I'm seeing here, what I'm seeing is impending volatility. And when I have impending volatility in a strong market, what does that tell me? Well, it tells me I should probably be day trading, right? Because if I stay short impending volatility in a strong market, then I'll be up on Wednesday, and then I'll be down on Thursday, and then I might be flat on Friday, right? And I took this entire roller coaster around the market, and ended the week up, basically flat, and with a bunch of stress for no reason. Whereas if I go into it and say, okay, well, these signals that I'm seeing right now for the first time in a long time imply that there's going to be some good volatility coming up in both directions, why don't I start every day with a clean slate and then just trade that, right? And then the next signal will develop, and we'll be here for it, right? And we'll show up, and we'll find the next signal, and there'll be clarity, and there'll be alignment, whether that's to the upside or to the downside. I don't really care, and we'll go from there. So that's kind of the tentative plan, but for those of you in the room, I'd like to see you on Tuesday, and I'll share my notes with you so that we can all get caught up with what I saw this weekend, because usually I'll find a couple of little idiosyncrasies over the weekend, so we'll cover those the next time I see you in the room. All right, guys, that's my time. Drop us a like, drop us a comment, and I'll see you next week. Cheers.